Welcome back to the channel. I have a special guest today from Rex Shares. Go ahead and introduce yourself.
Thanks, Brad. My name is Taylor Ranney. I've been with Rex for over a year now, but I joined to focus on and lead the distribution efforts across our income suite. So happy to get on and talk about our growth and income. And if we want to talk about FEPI, AIPI, and SEPI, we can do that as well.
So you actually came out with these new funds, and I own all four of them. And let's talk about these and how they actually, you create these positions. It's a synthetic. Can you describe what a synthetic is?
Yeah, so the synthetic exposure for the long component of each of these, what we call growth and income ETFs, is a long call, 1 month expiry, and then also a short put, same expiration, same strike price. That gives you essentially the long position. And then on top of that, because it's option and exposure, we can leverage that up, which we have done to 1.25 times.
So when you say that leveraged up, so you're not using swaps, how are you creating that leverage?
So with option contracts, you don't need to post 100% of the collateral for that position. So you're able to post collateral, which we do via treasuries, which, when you consider comparatively to swap, you're paying financing fees, you have counterparty risk, you also have less transparency. So through the option contracts, we're able to leverage the margin that option contracts allows us to. We post collateral through treasury securities, so we're experiencing some yield from that as well. So it's quite the opposite of financing charges. And with any ETF, you can see our exact holdings on a day-to-day basis. So the option exposure makes a lot of sense from our perspective here. And we treat the two legs of the portfolio slightly differently. So we have the synthetic long exposure, monthly expiration, as I mentioned, but then also the weekly pay that we're generating is from call option premiums. We're rolling those on Thursdays and paying on Wednesdays.
So since the longs are monthly written out, so you have weekend exposure to the market. So sure. Anything happens over the weekends, you have exposure to that.
That's right. Yeah.
Do you write some of these calls and have you back test them in the money, out of the money, or do you both in the money and out of the money, depending on what you're trying to achieve?
Yeah. So, it's a great question. It's incredibly important with the amount of different products in this space right now. And what I often tell clients is that not being the first to market in some of these products is, in my opinion, a benefit in that we can see how things have actually worked live in different structures. Then we can take that information, bring it back test different theories and theses that we can then bring forward to the market. And so with the growth and income strategies, what we really wanted to focus on was trying to create a portfolio and a structure that would, from a total return perspective, be very close to what you would get if you bought the underlying stock with distributions on a consistent basis. And so from that, we back tested a variety of different leverage ratios. So we went, everything from just delta one times exposure to 105, 110, 115, all the way up to 1.5. And 1.25 was the sweet spot that got us as close as we could to that underlying stock exposure. If you think about what we've seen since we launched, which we can certainly get into here, it really helps you. And considering these portfolios I haven't mentioned yet are 50% covered. So from a notional perspective, you have 62.5% after each reset to the upside. And then you have 100% on the rest of the portfolio for every month, every roll. It allows you to participate in rallies. It allows you to recover if any of these positions sell off or the underlying sells off. And it gives us just enough juice to be able to, again, recover back to a comfortable NAV level. We want to make sure that NAV is consistent. So when you are owning these securities, your dollar amount that you're getting paid out doesn't decrease materially over time.
Now you have 4 different funds, and all 4 of these funds that are currently out have actually had different market changes. The NVII has done well, and you have COII or COII that has performed differently, and Tesla has been kind of flat. Can you go through how each one of these and what your thoughts are when you look at the charts on these?
Yeah, it's funny because we have about 3 months of track record at this point. Typically, in my entire career, talking 3-month track record is not really indicative of what performance is going to be like. But considering the structure of these, what we've seen so far is actually really indicative of what we would have expected. And we're pretty pleased to see the outcomes, right? So you mentioned NVII. If you look at NVII since we launched the product, it's up over 29%. NVIDIA is up just about 27%. So in a market where NVIDIA has kind of just grinded higher, maybe not grinded, it's performed very well in the last few months here. We've actually been able to outperform that underlying exposure while paying out distributions. And we find that to be exactly what we're looking for in this strategy. Then if you look at Tesla and TSII, that's the market environment where Tesla has been very choppy. All of these stocks are high implied volatility. They're highly volatile stocks in nature. So, kind of moving up and down, you're down 15%, you're back to even. In that environment, TSII is up 3.3% and Tesla's down a little or closer to 1%, right? So again, almost 4% outperformance. And in that type of environment is exactly where, as you and a lot of your listeners know, you're benefiting because you're receiving those options, you're receiving the premiums and you're getting those distributions. And then hopefully you're maintaining NAV and maintaining that level of exposure to the underlying. So then MicroStrategy or MSTR, maybe it's just strategy nowadays, right? But MSII versus MSTR. MSII is down. It's recovered a little bit. It's down around 8%. And MSTR is down over 9.5% from a total return perspective comparatively, right? So now you're looking at an exposure, NVII, that's trended upwards, and NVIDIA, we've outperformed. You have Tesla, which is sideways market, choppy, highly volatile, outperformed, and then MSTR and MSII, down market. And again, we've been able to outperform. So it's really been able to hit on all those cylinders. Now, these are very idealistic in all of these, right? It's a slow grind higher, it's flat, a slow grind lower for the most part. Slow is a relative term here, I guess. COII is a different market environment. With all of these option-based strategies, they're very path dependent, right? So we launched COII in early June. Within those first few weeks of June, you had Coinbase up over or around 10% on multiple days across multiple weeks. So if you think about how we're structuring this portfolio with weekly rolls and weekly pays for the covered portion, we're relatively systematically writing 2% out of the money on a weekly basis, right? So if Coinbase is up 10%, right, we've missed out on part of that. It's not an entire 8% because we're still uncovered for a 62.5% notional exposure. But if that happens multiple times, you're now lagging, right? And so it takes an additional amount of time to be able to catch that. What then happened even to further that with Coinbase is Coinbase fell off pretty substantially, maybe 2 months after that or 2 months after launch. And because we have 1.2 times leverage within the portfolio, we're going to experience that downside 1.25 times, right? And so in that type of scenario, which is also why I'm hesitant to look at performance as being very indicative of future returns, is that's an incredibly volatile period where you have these moves that are not conducive to this type of strategy. But over the long run, we do think that it will, or it has the potential to revert back to a more normalized performance environment in which the structure, and that's another thing, right? We look at the marketplace of all of the other products that are out there, and you obviously want to see all of your products with positive performance, but that's not realistic. It's never going to be. That's not how markets work. But what I'm most proud of with these strategies is that they're all performing consistently relative to the underlying exposure. There are others where you're outperforming massively on one name, you're underperforming on another name. And if I'm thinking about, from a suite perspective at Rex, that consistency is really important to us.
When you reset those long calls, those monthly calls that you write out there, do you pay out any gains of those long calls, or do you offset them somehow? Other products tend to pay out any gains of those synthetics.
So the synthetic consists of buying a long call and selling a put. I think puts typically end up being a little bit richer than calls. I don't have specific numbers in front of me right now, but I believe that we're putting that back into NAV and not paying that out. My guess is that that is historically a net positive between, from the call premium that we're paying and the put that we're receiving. And we can talk about, and I think we should, the distributions from those strategies and how we're thinking about that as well.
Yeah, let's talk about it. How do you get this? Well, we know how you get the distributions because it looks like you're paying out just the short calls that you're writing every week.
So how that's very discretionary, right? From the PM's perspective. So the synthetic long exposure is very systematic in nature because we're just trying to get exposure. We're targeting the reset at 125 each month. But then in terms of what we're paying out in distribution, so these are growth and income. And as I've mentioned, already probably too many times on this, is that we want to make sure that NAV is relatively stable, or as stable as we can influence. And so if NAV is grinding higher, like what we've seen with NVII, we're going to pay out everything that we've received in premium from that week. If NAV is starting to drift lower, and that's going to be because the underlying exposure has started to drift lower, we have internal discussions from a PM perspective on what we think we should pay out. Because if we're paying out everything that we're receiving, then we're going to potentially start to see NAV fall farther. And if the goal of this is growth and income, we want to make sure that we're paying out consistently, but it's going to, the amount is going to float to some degree. And I just want everybody to understand that it's intentional. I've gotten some questions from clients around how we're calculating that. Not going to provide details on the specifics of that, but just know that that is an ongoing discussion all of the time. It is the discretion of the portfolio managers to try and make sure that the return profile is consistent and NAV is stable.
At the end of the year, you had to pay out 90% being a registered investment company, but you do get to net any losses. And I think that gets lost in the translation, that just because this week nothing went through the strike, next week it might go through the strike, and you can actually net losses out from an accounting standpoint, if I understand that correct.
Yeah. I mean, there's a lot of nuances to these strategies. I'm sure you guys have talked about tax treatment, return of capital, and 19A1 forms and how accurate they are relative to reality and what that actually looks like.
Yeah, risk management.
Yeah. So from a risk management perspective, first of all, the portfolio managers are using Bloomberg as a trading system. So all of the compliance rules and rules that we have around trading these strategies are codified into that trading system, right? So you have that as a kind of first layer of defense. The strategies are relatively systematic, right? There is PM discretion on where the strike is and the time of the day that we're going to trade, et cetera, and things of that nature. But you also have your natural checks and balances that PMs typically have and traders do, right? So if kind of the primary trader is putting on a new position and they're rolling the options, those all need to be then verified by a secondary trader before it's actually executed and sent over to be traded. So there are multiple checks and balances in place to make sure that we're not to minimize the human error impact, right? It's always a possibility. No one should ever go out and say that any of this is impossible, but we certainly do take risk management very seriously in terms of how we're trading, when we're trading, and ensuring we're meeting guidelines that we've set out.
If I don't ask the question, everybody will be mad at me. When can we expect the next growth and income funds?
It's a fair question. And at least it diverts the mad from you to me. We have filed for a slew of new growth and income funds. You can look up the filing, see some of the names that we have in there. I can't give you a date on when they're actually going to be launched. What I will say is here at Rex, we love to innovate. We love to be quick to market. We take feedback from our investor base very seriously. And so, I would just say keep an eye out in the near future and see where we're at with that. Hope that's fair. I know
fair comment, because I know that you can't talk about it, but if I don't ask,
yep,
somebody will say you didn't ask. So any closing comments for the audience about your funds and what we may see from Rex? I did notice that you have changed, and I noticed this last night when you had made your announcement on distributions. Something has changed at Rex. What's going on?
Yeah, we rebranded. I think when it was effective this week, I think it's a really nice, sleek design that we have, and kind of starts to bring, we're trying to really think about our suite holistically, because we do have a lot, right? We have inverse and levered products. We have the growth and income suite. We have our traditional covered call ETFs and FEPI, AIPI, and SEPI. Now we're starting to focus also on the crypto ETF space, where, we have a legacy private placement business on the crypto side and bringing that into the ETF structure. So right, we have a lot going on at Rex, and just excited to continue to kind of again take client feedback, bring it into the marketplace, and really be kind of one of those go-to providers for everybody. And the thing that I would like to just very as simply as I can for folks, because the majority of this discussion was on the growth and income, was just give you the kind of 30-second overview as simply as I can. And so again, what we're trying to accomplish with the growth and income suite is identifying a structure which we believe is 50% covered and 50% uncovered, with a 1.25 times leveraged long synthetic exposure. We're achieving that with a long call and a short put. And then simultaneously on a weekly basis, we're writing 2% out of the money calls, which are payable on Wednesdays. We roll those positions on Thursdays. If you're wanting to follow along and see how we're actually managing the portfolio. And the goal is really to be able to provide exposure to the underlying with distributions. So as close as we can. And I think we've been able to accomplish that. So if anybody ever has questions, you can certainly send them my way. I'd be happy to engage and be able to provide as much as we can. But if you think about the return of capital calculation, and it being essentially, if you look at an ETF's distribution rate minus an ETF's net income, and you kind of break that down, you can become a little more comfortable in, again, back of the envelope for yourself, in that an ETF's net income is going to be realized capital gains plus dividends plus interest minus the expense ratio. And so with some of these distribution rates being so high, and even if you look at like FEPI, right, 25%, for the ETF net income to be close to that, your performance in that underlying in the ETF itself is going to be fantastic, right? And so that is it's almost a Goldilocks scenario for the fund, maybe not for taxes. But with that being said, I mean, FEPI, again, monthly rebalance, you're going to, depending on what the market's done, experience realized capital gains in that period, or losses, and they offset over the course of the year. And then, the accounting firms and fund administration, everybody get together and they finalize what those numbers look like. But it sounds like everybody at this point is starting to become very comfortable with the potential tax or the power of those tax treatments. But it's nice to hear that, because a year ago, I don't even think it was well understood.
That's right. And I always recommend seek out a good accountant that actually knows what return of capital is, because not all of them actually, from an accounting standpoint, know what that is. But there's good ones out there that does. Let's talk about, and we're going to throw an oddball at you. You have a fund on Solana.
Yes.
How has that done on that fund? And you don't make calls on that. That is just the staking rewards, correct?
Yeah, that's correct. So we launched SSK, which is the first crypto ETF in the United States with native staking assigned to it, or not assigned to it, but as part of the product itself. And so we were able to to get that out to the market very quickly. So we were proud of how we were able to accomplish that.
That fund has seemed has seemed to do well from what I've looked at the charts.
Well, I think Solana's done fairly well, which helps, and the staking rewards certainly do help. I think, you know, from our perspective, Solana's one of those coins, and I don't want to get myself out of my depth here on the crypto side yet, but that seems to be the backbone of a lot of the developers on the blockchain and crypto side at this point. And there seems to be a really strong case for Solana moving forward. So we've seen a lot of interest, you know, gathered, and we've garnered a decent amount of assets within the product. So, you know, we're going to continue to push that forward and the effort on the crypto side pretty meaningfully as we move forward over the course of the next year or two.
And of course, this is all totally unrehearsed because my next one is BMAX.
Yes.
How has that performed, and what's your thoughts on that?
I got to look at actual performance of it. BMAX is a really unique and niche exposure. I do own it. I love the idea of it. And it's essentially looking to buy the convertible debt from companies like Strategy, which have transitioned their corporate treasury to essentially hold Bitcoin, right? So they're able to finance convertible debt at rates of even as low as 0% and bringing in billions of dollars for the sole purpose of buying Bitcoin. So it's really kind of structuring, again, their corporate treasury to be, you know, less of a liability and more of a long-term asset. And if you believe in the crypto ecosystem, you know, Strategy ends up being a bit more of a levered play. Now, convertible debt has an asymmetric return profile because the bond can be called. And so there's an embedded option within it. And so as the market moves higher, you start to become more exposed to the underlying stock. So in this case, like MicroStrategy as an example, we have Mara Holdings and Riot and a couple others within the portfolio as well. A way to get more crypto or broader Bitcoin type of exposure.
Sure. I just saw that today cruising your website and said, I haven't talked about that since it came out. So thank you for explaining what it is, because that's really not for the retail investor, but the way that you've packaged it, we can now have exposure to it if we want it.
I think we viewed that as very much an access vehicle. It's a part of the market, and convertible debt ends up being, you know, if you think about BMAX, you have to have people understand Bitcoin corporate treasuries. They have to be believers of crypto, and they have to understand convertible debt, right? And so it's once you understand it, it can be a powerful piece of a portfolio, but getting that level of education out is incredibly important. And it's kind of that multi-tiered. So, you know, access is for everybody. It's for advisors if they have access on their platform. It's for retail investors if they want to dive in and get some differentiated exposure. And, you know, with Bitcoin at all-time highs and people, well, maybe not at the moment, and people always looking to kind of buy the dip, it's a different way if you want to get your toes wet and kind of, you know, get some exposure.
But let's talk about FEPI and AIPI real quick.
Sure.
They were my favorite child, but that was what I'm going to call revision 1. That was what was out on the market. The new funds come out and the growth in income funds, but they haven't done that actual bad. Give us your thoughts on FEPI and AIPI and maybe some lesson learned on those and what we should expect, not forward guidance, but what we might expect out of these funds going forward.
No, I mean, thanks for bringing those ones up, because I think they do serve different purposes than what growth and income does. And it's similar to my comment before where, you know, I mentioned not being first to market can have its benefits. This entire segment of the ETF ecosystem was almost non-existent 5 years ago, right? Maybe it's 6 years now. You had Global X in the marketplace for a long time with their more diversified strategies. And every step of the way, there's been iteration after iteration, innovation, and evolution of these, right? And so that's a way that we got to the growth and income suite. What we started with FEPI was, again, looking at the marketplace, and you look at the big JP Morgans and now Goldman Sachs and NEOs, they all have incredible strategies. They're all built slightly differently. And the way that we approached that was to say, if we focus on concentrated baskets of securities, there is an asymmetric relationship between the level of implied volatility and the amount of estimated premium that you can collect from those individual names. And if you're writing at the index level, the implied volatility of those positions have already experienced diversification benefits, and therefore their implied volatility is subdued relative to the individual securities. Now, that doesn't mean you don't get diversification benefits in something like FEPI. FEPI is the 15 largest and most liquid US tech stocks, equally weighted. So it's a relatively diversified approach to a concentrated basket. And what we've been able to do there is take advantage of that asymmetric relationship, right? And the NASDAQ 100 could have an implied volatility around 20. Some of these names can be 50, 60, 70% implied volatility. Right? So the amount of premium that you can collect from those strategies is substantial. And that's one piece of it. The other piece is out of the moneyness. So in FEPI and AIPI, we are typically going to be writing 5 to 10% out of the money for FEPI, and it's been historically closer to 3 to 10% with AIPI. To give you a little bit of additional information there on the premiums that we've collected. So since we launched FEPI, so October 2023, we've distributed our 2.1% per month. That's not strict by prospectus. That is a soft target that we want so people have some idea of what the distribution will be going forward. You can look at NAV and you can do a back of the envelope calculation, get yourself pretty close. But we've collected over 2.6% in premiums on average per month in FEPI. In AIPI, we've distributed 2.9% per month since launch, and we've collected close or just over 3.8% in premiums per month on average. So from a support perspective, in terms of our distributions, they're very well supported by the premiums that we're bringing in. And not all of, but FEPI, AIPI, and SEPI for that matter, are all 100% overwritten. So different than the growth and income series where it's 50% overwritten. The primary objective with FEPI and AIPI and SEPI is more income focused. Now, that is in the context of total return. It's the same thing that I'm mentioning, for the other strategies. We want to make sure that NAV is stable, because if you're looking for a 2.1% monthly distribution and it's on a 50 NAV, it's a very different dollar amount than a 40 NAV or a 30 NAV or a 20 NAV. And that, I think, can be misconstrued, and it's important to contextualize that.
Well, greatly appreciate your time, and thank you for coming on to the channel.
Thanks, Brad. It was a pleasure.